Bloomberg Audio Studios.
Podcasts, radio, news.
Okay, we're going to go wonk on you now as we go to Richard Clarida, who changed Columbia economics forever now at PIMCO, and we're thrilled the vice chairman could join us this morning. What an honor to have Michael Spencer, the laureate, and Richard Portis of London Business School talking about John Hicks. And long ago, there was a thing that was invented called the Hicks-Hansen model, which now we call the ISLM model. And the bottom line is the financial media completely focuses on financial LM dynamics, money, this, the interest rate, what's inflation can do. Oh yeah, there's an IS curve which has to have the real economy on it. Rich Clarida, is this Fed completely riveted to inflation, or can they perchance look at the American labor economy?
If you'd asked me that question, which I think you did 2 years ago, I'd say they're focused on inflation because it was too damn high. Fast forward to today, they're saying, and I believe that they do see the risk is two-sided. I think if we did see a sharp slowing in the labor market, they would respond because inflation is now close enough to target. They can afford to be flexible. 2 years ago, when inflation was 6-7%, no. With
the fancy PhDs, all from Columbia at the Eccles Building, when you quote-unquote focus on labor, by definition, you're ex post. You have to wait for the labor economy to break. You can't anticipate it at a given central bank.
That's a very fundamental question because ideally central bankers, including on my own research with Gertler and Galley, in a perfect world you would anticipate. If you saw the labor market slowing, you try to get ahead. That's forward-looking monetary policy. As I learned in practice, however, the economy is always changing, and what was a good model 5 years ago may not be a good model now. So there's a real element of risk management as well. But I will tell you, a good example of that, Tom. During my time there, the models were saying, you guys got to keep hiking rates because the unemployment rate's at 4.2%, and our models say inflation's coming. And Jay Powell and I, the committee, didn't see inflation. So we didn't hike rates in 2019. In fact, we cut a little bit so the economy could keep going. So there's risk on both sides, and I think good monetary policy needs to be nimble and assess that.
Central bank inflation targeting, Richard, this is something that, we felt, at least in emerging markets, that central banks had found religion. And here we are, and we're seeing central banks cutting in the face of a Fed on hold. And my question for you is, how long can that last?
This divergence. Certainly, I think there was some talk at the beginning of the year other countries would not even begin to cut until the Fed did. I never believe that. And I see we have already seen Sweden. We've seen Switzerland. We're almost certainly going to see Madame Lagarde and the ECB tomorrow. So I think certainly central banks can get those rate cuts started. And I think they could proceed much further than the Fed if their inflation data supports that decision. I think the challenge right now in Europe and the UK is the inflation data at best is moving sideways, and some measures is moving up. So that may limit the number of cuts they get in this year, not because they're focused on the Fed, but because inflation is not cooperating.
You just hit the nail on the head. Look, inflation is not cooperating right now with the ECB, and Madame Lagarde this is an interesting experiment, Tom. Can the ECB, it's 25 bips. What are they going to cut the depot rate to 4.75? Is that really going to juice growth in the Eurozone? Do you think that's enough? Do you think they're going to have to continue to go more, or can they cut, pause, and wait and see what the Fed does?
My guess now is that they will pause, in the sense I don't see them moving at the meeting after the June meeting based upon the data now. In fact, maybe just to venture, there could be a little bit of seller's remorse because they really signals this rate cut beginning in March, and I think they're going to get it in, and I think it makes sense to get it in. But I would not extrapolate from this that it's going to be every meeting. I really do think, and I saw a wonderful speech that Madame Lagarde gave at the ECB Watchers, where I also spoke in March. It was one of her best speeches, and the message I got from that is she is very data dependent, and if the data doesn't cooperate, I think that's going to be a factor.
In her Jackson Hole speech, which we covered, it was the same idea. Okay, we're data dependent, but let's have a longer vision. Richard Clarida, I have to have a nerd book of the summer, and it's Adam Posen's fault. We'll blame him, out of the Peterson Institute. Maurice Obstfeld and Doug Irwin talking about trade, talking about what's out there. And all of this, and we're going to get Brad Setzer in here, but it's the idea of deglobalization. The Fed's got to worry about the rest of the world as well. Do they work within regional trading blocks now, or do we still have a vibrant trade economy that can be part of our growth?
Well, obviously, globalization, I think it's clear, has peaked. And so the real question for the next 5, 10, 15, 20 years is what does onshoring, friendshoring, supply chain rethink, how does that translate? But I will say it's very relevant, Tom, to monetary policy, because in the 30 years before the pandemic, globalization made the Fed's job easier because it put downward price pressure on goods and in labor markets. And if it reverses, that means at the margin, the Fed's job is harder. Right
now, and this goes to the meeting next week, you've got a partition of domestic final sales, which are actually pretty good. But I'm sorry, you bolt on a few other statistics, including trade, and it's a sub 2% economy.
Yeah.
Which is it?
My own sense is that we're heading down to around a 2% economy with a risk that we could overshoot in the other direction. I think it's too soon to tell, but some of the data, including the Bloomberg Surprise Index, it has moved into negative territory. We saw Atlanta Fed mark down from 4 to 1.8 in the last couple of weeks. So bears watching.
Rich, we talk about data dependence here in the U.S., and we have two big data points coming out. We have the ISM services coming out tomorrow and then followed by payrolls, but I think it's those subcomponents. So I'm asking you, what are you really looking at within the data? Are you looking at prices paid, new orders in the ISM data? Are you looking at, labor force size, average hourly earnings? I mean, what are you most focused on over the next couple of days?
At some level, the flip answer would be all the above. Certainly when you're at the Fed, you are looking at everything. But I would say that if I had to prioritize, I'm focused more on the cost side of the economy right now, in the sense that everyone agrees that the labor market needs to adjust to be consistent with the inflation mandate. And I would say that the numbers there are encouraging. We've seen a big deceleration in wage inflation. That may create some political problems for the incumbent, but from the Fed's point of view, it's moving wage inflation in the direction of consistent with price stability, unlike, for example, what we're seeing in the Eurozone and the UK. So I think labor market and the cost side of the economy is what I'd be focused on. I think the demand side will take care of itself.
I'm out of time. Can you come back?
Of course.
There's a Fed Day next week. If we can get you on for Fed Day, great. Richard Clarida, thank you so much. The former vice chairman of the Fed. I can't say enough about what he did to rebuild Columbia economics a number of years ago. He's at a small shop where they play golf, PIMCO.
Small.
Out on the West Coast.